the days of the US dollar being the world reserve currency are numbered. I think we're in the, I don't know, we don't do too much baseball over here, but I think in the seventh inning at least.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at SDBullion.com. Now enjoy this interview. Welcome to Rethinking the Dollar. Today I'm excited to have first-time guest, Mr. Ronnie Stoeferle. He's an Austrian investor as well as a fund manager for Incrementum Investments management company, and also the author of In Gold We Trust report. So Ronnie, welcome to Rethinking the Dollar.
Hi, Mike. Thanks for having me.
Well, I appreciate you taking time to sit down with us. Definitely looking forward to getting your thoughts on a variety of subject matter. So you're over in the European area, so I definitely want to find out what's happening in that area and get your thoughts on what's currently going on this side of the planet as well. But before we dive into that, first question I tend to start off with is, what comes to mind when Ronnie hears the words rethinking the dollar?
Well, the first thing probably is de-dollarization. I think the days of the US dollar being the world reserve currency are numbered. I think we're in the, I don't know, we don't do too much baseball over here, but I think in the seventh inning at least. There are many signs that actually the whole world wants to diversify out of the US dollar. We're seeing so many bilateral agreements between emerging market nations, between Russia and China, for example, Saudi Arabia as one of the most important oil producers, of course. We're seeing that many countries like Russia, China, India, Kazakhstan, Turkey, Iran are buying more and more gold for their central banks, but also their private individuals. So I think that, you know, every couple of decades, actually, we're moving from one world reserve currency to another world reserve currency. Normally, those times in between are pretty let's say exciting, volatile, turbulent, whatever. And I think that many people in the space saying that, you know, the renminbi will be the next world reserve currency, I think that's far too early. I think the depth and the sophistication and the structure of their capital markets isn't ready yet, but they're working on that, and they're working very hard on that.
Right, and I appreciate you for sharing that. And so I'm curious to get your thoughts on, at this current moment, we're approaching the end of 2019. A lot of things are currently going on. What are you and your research firm keeping an eye on the most? What concerns you the most at this current point?
Well, of course, the U-turn by the Federal Reserve, but in general by central banks is extremely important, and I think that we're at the moment seeing some kind of early signs that governments, politicians, and also central bankers want to prepare us for the next recession. We had many studies coming out about you know, the advantages of negative interest rates. For example, there was one paper by the Federal Reserve San Francisco coming out just recently. There are more and more Fed representatives making the case for lower rates, for even negative rates, for another round of QE. And I think the big topic that really picked up in momentum recently is the topic of MMT, of helicopter money, of QE for the people, whatever you want to call it. And I actually read a very interesting piece by the BlackRock Research Institute. Of course, BlackRock is not an unimportant investor globally, and they're making a clear case for MMT, how it might be implemented. And I think we should be certain that fiscal stimulus is the new monetary stimulus. So in the next crisis, and perhaps we're also already at the beginning of that, expect much more fiscal stimulus than central bank intervention, because central bankers said, okay, they basically did their jobs there. They have moved into uncharted territories. So now it's really time for fiscal policy to become much more aggressive. And what's the consequence for investors? normally fiscal stimulus acts much more directly for, you know, the economy, economic growth, but also for inflation. So I think inflation for the next couple of quarters will become a big topic, although nobody is really concerned at the moment. But this is, and that's, you know, politicians and central bankers are very, very open about that. This is what they want to achieve, yeah, and inflation, at least price inflation, has been undershooting, and they want to make up for that. So I think inflation surprises might be really a big topic going forward.
All right. Now, you mentioned to lead off saying negative interest rates. So we're currently on the race to the bottom. So it looks like globally all central banks to stave off this next recession or correction in the economy, basically trying to extend this boom and bust cycle a little bit longer, or the boom aspect of it. They're removing the actual pricing of money. And so currently when it comes to borrowing, if there's no incentive to borrow because you're not rewarded for it, that definitely has to change the dynamic of borrowing for governments as well as for citizens, but it benefits governments especially if the debt is yielding negative territory. Can you speak to that for me a little bit?
Well, I actually just published a book on that topic. It's called The Zero Interest Rate Trap, or in German, Die Nullzinsfalle, but it will be translated or will be published in English very soon. And in this book, we're not only explaining the negative consequences of zero interest rate policy for our capital structure, and how it weakens the economy, how it manipulates time preference, how it leads to enormous boom and bust cycles, and now, I mean, let's face it, we're in the everything bubble. So we're not only seeing equities at record high valuations in many countries and areas, we're also seeing 15 trillion in bonds trading at negative yield. So it's a guaranteed loss. We're seeing the art market going crazy. We're seeing real estate markets all over the world trading at all-time highs. So it is obvious that this monetary inflation led to a big boom, but we also know that we're now extremely dependent on cheap money, on permanent capital infusions by central banks, and for the system is extremely fragile nowadays. So, but this is only one side of the story. In our book, we also explain the consequences for our society and for culture, and it means that our time preference nowadays is so high that nobody cares about, you know, the longer term. And one example that we're coming up with is tattoos. I don't know how it is in the US, but over here, everybody is getting tattoos. Now, I mean, from my point of view, everybody can do with his body, whatever he wants. It's totally fine for me. But it's just a sign that people want to have, you know, they want to consume now, they want to have their tattoo now, and they don't care how it's going to look like in 10 years, because let's face it, after 10 or 15 years, every tattoo looks horrible, but nobody cares about that. So I think those consequences for our economy and how it basically turns the whole capitalist system and the whole monetary system upside down. I think this is really something for history books, unfortunately. And of course, there are many ways out of this. And from my point of view, a pretty good insurance or hedge for such extreme scenarios is, of course, gold. And that's what we are describing in our annual In Gold We Trust reports.
Right. Way to assess that and compare that to the whole idea of consumption at this current moment without future consequences. And so over here, we call that kicking the can down the road. And so we have a government here that's bent on doing that very policy, to where it's become very common to expect politicians to just basically deliver promises without regards to who's going to be footing the bill. And so currently, you mentioned fiscal policy, MMT, being the next round of policy implementation. Therefore, more promises. Therefore, more intervention of government into society. And so it seems like, can you kind of can you kind of assess that socialism and those type of policies will become the future in place of capitalism, perhaps?
Well, I mean, we could, of course, discuss if we're really living in a capitalistic system. If that's real capitalism, I mean, over here in Europe, you know, the government, the state is dependent or responsible for more than 50% of our GDPs in most countries. I think in France it's 55%. So I wouldn't say that it's a true capitalist system. However, in our most recent report, we're describing this erosion of trust, and we're not seeing that trust is eroding in politics. I mean, it's you know, populists on the very right, but also on the very left side of the spectrum, winning elections all over the globe. It's not just in Europe and in the US where the society gets more and more divided. It's all over the world. Then we're seeing that people are completely losing trust in traditional media. I mean, just have a look at the numbers of, you know, cable net, traditional news stations and cable networks, newspapers, and so on. So people are losing trust in media, in traditional media. Then we're seeing it for big corporations. We're seeing it with religion and so on. So it is a sign of our times. And what really scares me is we're quoting some studies where they surveyed students at US universities, and actually they don't care about democracy anymore. So we've got the lowest level of young people having faith in the democratic system. They want to have a strong leader. And that's something that scares me a bit, I would say. And we shouldn't forget that now, at least on the surface, everything is fine. You know, stocks are doing fine. We've got real estate doing well. So we have this kind of wealth effect. But let's compare it to the so-called Occupy Wall Street movement. Back then, I think it was 2010, 2011. That was rather peaceful. But I think if stock markets would crash now, and if banks would be bailed out with huge packages, I think there would really be a pretty much different environment, and people were really upset and rioting. So this is something that definitely concerns me. And, you know, having a look at the programs of Elizabeth Warren, Bernie Sanders, I mean, I think nobody really cares about fiscal, a solid fiscal policy and sound budgets and if you compare it, for example, to the campaign or the election, I think it was Ross Perot against Bill Clinton. The main topic in the election campaigns was how to reduce the deficit and actually how to get the budget under control again. Now nobody cares about that. Actually, Democrat candidates, you know, they want to hand out everything for free, healthcare, of course, college tuition, a Green New Deal, whatever. Yeah, that's the road to serfdom, and we're, I think, as many Austrian economists clearly analyzed already decades ago, this will probably lead to a much more socialist system, and that's definitely a big concern.
All right. It's a very big concern for me because we're in a political season right now where there's a lot of back and forth amongst different left, right, to me, ultimately all of the same mindset. But yet I think there are some things brewing under the scenes that we're not being told, and it's starting to rear its head above ground in regards to the whole repurchasing of assets by the Federal Reserve Bank and the repo markets and all the things happening with that. And amongst the LIBOR situation, which is also coming to an end. So I'm assuming something behind the scenes with regards to liquidity for the banking sector is starting to become obvious. What are your thoughts on that? What's your assessment of that? Is that the beginning of something that's going to be, you know, official in the form of quantitative easing?
Well, officially they said no, it's not quantitative easing. I mean, if they're buying 60 billion per month in T-bills, that's definitely a sign that not everything is just fine. We've got so many signs for a recession coming up. We've got the yield curve that was inverted, a very reliable signal. We've got the Fed New York's own recession indicator at roughly 40% recession risk for the next 12 months. We are in an earnings recession. Just have a look at the numbers coming out. They're especially below the surface, they're really, really weak. ISM indices are weak. And it is not just in the US, it is actually some sort of global cooling. So it is obvious that we are on the way into a recession. Perhaps we are already in a recession, because normally it is only officially announced 9 to 12 months after. So normally when they officially announce the recession, it's already time to start buying. And I think that gold is kind of sniffing that out, because gold is a very, very reliable recession hedge, because it discounts future monetary stimulus and future monetary fiscal stimulus that will be kicking in a recessionary environment. So there's quite a lot going on. You mentioned the repo market, for example. There might be really a big company having severe funding problems. That's what my sources tell me. I think it's pretty clear that all those comments coming out just recently. Let me quote that. If the entire system collapses, the gold stock provides a collateral to start over. A gold bar always holds value. This makes where is it? This makes shares, bonds, and other securities have inherent risk. Gold gives confidence in the central bank's balance sheets. That's not something that somebody on Twitter said, or on Zero Hedge, or whatever. That is actually the Dutch National Bank saying that in an official statement. And I think the fact that so many central banks in the last couple of quarters started buying gold, that they announced that they're repatriating their gold, this is definitely a sign that there's something happening behind the curtains.
All right. Thanks for watching this interview. If you're enjoying content like this, feel free to become a part of the RTD community by becoming a member via Patreon. All it takes is a monthly contribution of about $5 a month for more great content such as this. Just scroll down beneath this video here and click the Patreon link, and then hit this tab right here to become a member of the team. Looking forward to bringing you more great content. Now, let's get back to this interview. Thanks. I would agree. And also, I wanted to just get your thoughts on just a recent announcement that I'm hearing on this side of the planet, is that Germany has decided to increase their reserves as well. And some graphs that were positioned on the internet showed a decrease of their holdings over the last 2 decades. And all of a sudden now it's a spike up. And it kind of resembles the Federal Reserve balance sheet in one regards of them, lessening their holdings, but then all of a sudden now increasing in T-bills, but yet Germany's increasing in gold. So clearly there's something happening behind the scenes, and metals is included in it. Would you agree?
Well, regarding Germany, I think it is a bit of a misinterpretation that was made. It was from Bloomberg journalist, and I think Germany didn't really start buying gold. It was mostly for technical reasons. I think they needed some physical gold for coins. So I honestly have to read it in detail again. But I think it was a big story was made out of it. I don't think that this is really a big topic now. But what is, from my point of view, really crucial is to understand that gold was going in the last couple of years, where gold corrected, or the gold price corrected, from weak hands, mostly in the Western world, to strong hands in the Eastern world. As you know, we published in Gold We Trust report for the very first time in Mandarin. So there's a Chinese edition now as well. So I traveled to Hong Kong, to Shanghai, talk to people there. And actually, their time preference is so much different. They don't care about daily noise, daily price fluctuations. They're really in for the long game. And therefore, perhaps at a gold price of 5,000, 10,000, whatever, they will think about selling again. But if gold is at 1700 or 1800, I think it's not coming into the market. And this is something that many people underestimate. Gold always goes where the capital structure is improved, where there's real growth happening, where people appreciate the long-term value of physical gold. So I think it is really important to understand those dynamics. Have a look at the export statistics. Those numbers that are actually moving and flowing from the west to the east. They are mind-boggling.
Right, I agree. And so I wonder, just as we get ready to draw down towards the last couple of questions here, the power shift, as you hinted at, from Western hands to Eastern hands is becoming more obvious now. And so clearly there's plans for gold implementation as well as the silver, I'm assuming as well, into the monetary realm in some form or fashion to probably reestablish trust. Now, so based upon your guess or your hunch or opinion, the whole One Belt, One Road initiative is something that is not really getting much information shared on this side. But we well know it's well underway, and the whole linking the whole maritime rights and all that stuff is up and running. What role does gold play in that, do you think, in your opinion?
Well, it plays a big role, obviously. We wrote a big chapter about gold in China, about the tradition of gold in China, about the monetary history of China, and also about the new Silk Road, so the One Belt, One Road initiative. And actually, the most important countries on that road and on that line, they're actually big gold producers, and there are big gold mine developments going on, and they're actually pretty big and important gold markets. We should not forget that China nowadays is the biggest gold consumer, but also the biggest gold producer, and many other countries that are very active in this infrastructure development are also big gold nations. So I think it is definitely one sign. As I've mentioned at the beginning, there's so many signs basically on a daily basis about this de-dollarization topic. It is really something that is picking up momentum at the moment. We quoted, for example, some very important representatives of the European Union openly questioning the US dollar as world reserve currency, saying, why do we pay for most of our energy imports in US dollar terms and not in euro terms? So I think it's really becoming more and more important. And the fact that Donald Trump is so nervous and that he's pushing or putting so much pressure on the Federal Reserve. This is something that we haven't seen in decades, that the White House is really pressuring the Federal Reserve. And I mean, he even called them boneheads. So I think he's really concerned because the recession signs are getting stronger and stronger. And of course, he wants and he needs a weaker dollar. And actually, I think at some point, a weak dollar would probably be a pretty good stimulus for the world economy, and actually this might be something that might be on the horizon. So I'm structurally relatively dollar bearish, which would of course on the other hand also be pretty positive for gold. But let's face it, gold is rising in every currency. It is up, I think, 17% in dollar terms. It is up 20% in euro terms since the beginning of the year. The world gold price is trading at all-time highs. Gold is trading in euro terms, Canadian dollar terms, Australian dollar terms, and I think 50 other currencies at or very close to new all-time highs. So we're in a bull market, and the interesting thing is that most people didn't really recognize it yet, which is a pretty good sign.
Now, as we draw towards the end of our conversation, I'm curious to get your thoughts, because we talk a lot about gold, but not much words on silver. And so gold-silver ratio it's been extremely distorted. Silver also plays an important role, especially for a lot of my audience and my viewers. So where does silver fit into this equation as well?
Well, silver, it's I would say it's a sentiment indicator on gold. So at the moment, with the gold-silver ratio trading at roughly 85, that shows you, okay, there's not too much excitement in the precious metals market yet. And we have seen that this gold-silver ratio actually reversed. It was significantly high. It almost hit 100. So if my assumption and my analysis is correct that we're in a new gold bull market, then silver will definitely outperform gold. I mean, the ratio normally is 3-to-1. So if gold rises 1, silver rises by 3. On the upside, but also on the downside. So if you can live with the volatility of silver or even silver mining stocks, I think it's an interesting idea. As soon as there's real momentum coming into the gold market, I think at some point people will say, why we should consider buying some silver. And we all know that the silver investment market is extremely small, and that actually if there's just a very, very minor move and a minor flow of capital into the silver market, this will have a huge impact. So from our point of view, we just got a full inflation signal. So in the fund that I'm managing, for example, we're at the moment buying silver mining stocks, really loading up on inflation exposure, also commodities and so on, because it is an unloved sector, and I think the fundamentals but also the technicals are really in place now. So yeah, it's gonna be a hell of a ride.
Interesting. Well, very last question, Ronnie. Blockchain technology, something that has been introduced since the last great financial crisis. Therefore, a lot of people are excited about the opportunities that have come from it, such as Bitcoin and all the projects and the corporations that's shifting towards utilizing that technology. Where does the blockchain, in your opinion, fit into this next role of monetary or industrial or whatever role in the future?
Well, we're not only writing the In Gold We Trust report, we're also writing a quarterly crypto research report, because we want to educate people and also especially investors about the crypto market, about the opportunities, but especially the threats in this sector, in this very new sector. From my point of view, it's no coincidence that gold or that Bitcoin has a very similar stock to flow ratio like gold. So this natural inflation of Bitcoin is actually falling with every halving, and that's a very, very important thing that people should consider more. I think this relative supply curves of gold, but also of Bitcoin relative to fiat money are very important to understand. And I think that, first of all, I like competition. I think competition makes products better and cheaper. And I think, why shouldn't there be competition in the currency space? So it is normal, it is healthy. I know many, many young people that are actually, coming into the crypto scene, and then they start reading stuff, they order books, and then they say, okay, why? Now I know how money is actually created. Is it really like that? Because you never hear about that. It's not taught at school or on universities. And I think this is a great thing that people are discussing and questioning our monetary system. They're discussing alternatives. There's quite a lot of human capital in the sector. So it's a positive development. From my point of view, I'm not sure if Bitcoin will be around in 10 years' time. If it will be around, it will be significantly higher, of course. Will gold be around in 10 years? Absolutely. And I think that it will perfectly preserve and also increase your purchasing power. But I think at least some small allocation of Bitcoin or perhaps some other cryptocurrencies definitely makes sense in every portfolio.
Right, I do agree. Well, Ronnie Stoeferle, it's been great having you here on Rethinking the Dollar. For those that might want to follow your work and stay in tune with what you have going on, can you point them back to your direction so they can be a blessing to your work and your channel?
Absolutely, absolutely. So, this is the In Gold We Trust report. We're publishing it for 13 years now. It is quite a brick. So this year we wrote more than 340 pages. It is available for free on our webpage, ingoldwetrust.li, which stands for Liechtenstein, where our company is based. You can download this year's report in a compact version, which is roughly 100 pages, and in the extended version, as I've said, 340 pages in English, but also in German and now also in Mandarin. You can download all our previous editions as well on the webpage, everything for free. You can sign up for our newsletters. We're about to publish a new chart book on gold, which is basically a summary of the insights of the In Gold We Trust report, just with brilliant charts that people love, and just short interpretation of those charts. I wrote a book about Austrian investing between inflation and deflation, because I'm not only from Austria, I am also a keen follower of the Austrian School of Economics. And my new book, The Zero Interest Rate Trap, will be published in English very, very soon.
Sounds good. Well, once again, Ronnie, it's been great having you on Rethinking the Dollar. Definitely enjoy this back and forth. Looking forward to hopefully having you on in the future as things begin to poke their head above ground, and we get a chance to get your thoughts and assessment then. But other than that, Ronnie, thanks for joining me on Rethinking the Dollar.
Thank you very much. Have a good one. Bye-bye.